everybody, it's Gene Marks, and welcome back to another episode of the Hartford Small Biz Ahead Podcast, part 2 of our discussion with Joey Korenman. He's the founder of School of Motion and co-founder of Rolo. Joey, first of all, thanks for coming back.
Oh, thanks for having me, Gene. It was fun last time, so let's see if round 2 is just as fun.
Keep it going, right?
Scales.
So again, for those of you guys that did not watch the first episode, and shame on you, you should go back and watch it. Joey gave us a whole big background of his companies, both School of Motion and Rolo. Talked a little bit and offered some advice for people that might want to set up online videos for whatever purposes, and you know what he's learned, some tips, some thoughts on that, and then also discuss a little bit about what Rolo, which is really, Joey, the best way I can describe Rolo is just it's a recruitment service for all of your students that have come through your school to try and connect them with
synergy.
Yeah, it's that synergy thing, which is great. So 2 great things. School of Motion has been around for over 10 years, correct? So,
yeah, it has.
Okay. So let's talk a little bit about the business, though, and about buying businesses, because you've bought, you said a few businesses over the years. What acquisitions have you made? I know we're not giant acquisitions here, but they were acquisitions. Tell us a little bit about the businesses that you've purchased over the past few years.
Yeah, sure. So these are mid 5-figure acquisitions. These aren't huge businesses, right? So the 2 businesses that we acquired, one was called Holdframe and one was called MoGraph Mentor. And both of these were training products that were aimed at the exact same audience as us, motion designers. And so the reason that we bought them is kind of interesting. So I have a good friend who, I don't consider myself like a business person. Okay. Everything I've learned about business, I've learned like through doing it in service of actually running a business. But I have a friend who like has an MBA and went to business school and really understands like the ins and outs and can look at can read like a P&L and stuff like that. And so anyway, so he put this bug in my ear. He had me read this book called Buy Then Build. Okay. And the idea in the book, if you read it, it's really interesting. It's something that never occurred to me. And I'm sure like a lot of creative people, this just isn't the type of thing you think about, is that I want my business to grow. And my business really relies on having products to sell and content to promote those products and things we can give away for free as lead magnets. And when you get to a certain size, everything you do becomes expensive, right? So for us to put together a new product, like a new course, it takes a lot of time, takes a lot of money. It takes a lot more time and more money than it did when it was just me, because now, everything kind of slows down when you have a team. There's pros and cons, obviously. And so one of the strategies to get around that is you can look around and there's a lot of businesses out there, little micro businesses, where you have like a solo creator making amazing, incredible stuff and they have no idea how to market it.
Right.
Or they just don't have time. And so they don't have an audience. So they have this amazing thing and no one to sell it to. And what you can do if you have an audience, which we have like amazing distribution channels, is you can buy their product and sell it to your audience. Now that part's pretty intuitive. The part that wasn't intuitive to me, because I'm thinking to myself, well, that seems risky. Like this guy's asking for $50,000 for this thing that in the whole lifetime of the product has made $50,000 over like 3 years it's existed. So that doesn't seem like a good deal for me. But then you can look at it and you can do the math and you say, okay, well, if I just take the product and I just sell it to my audience, because I'm good at marketing,
okay.
How much do I think I'll make? Well, it's more than $50,000. So how about this? How about I say, yeah, I'll give you the $50,000, but I'm only paying you out of the proceeds from selling your product. And if I don't get to $50,000, then we're going to sort of split the difference. And you can get so creative with terms when you're acquiring a business, where you can basically completely de-risk yourself and acquire the thing for $0. So there was $0 out of pocket for that deal. And then for another deal, I think we put down maybe...
I got to stop you. Wait,
go ahead. Yeah, dig in.
This is great. And you're absolutely right, about how you can structure a deal like this. First question I have for you on that, though, is that were you buying just the product or did you buy the guy's company?
So it was an asset sale, technically, but we acquired everything. So the idea was we acquired the brand, and what we actually did, because that brand had some brand equity, the owner was like pretty well known in the industry. And so what we did was we sort of folded it in underneath the School of Motion brand. So if you go to School of Motion's website right now, you'll see a button at the top that says workshops. And when you go there, you'll see all of these beautiful products. And so what we did was we acquired not just the products that were being sold, But we also part of the deal, part of the acquisition price was basically putting the owner on salary, like a small salary, for about a year and a half, spread out, and he helped us create new products that we then sold. So that was kind of how we financed it.
Which was going to be my next question.
Yeah.
And so you're talking about like, well, you're going to spend $50,000, and like that's still they've like had over, but you didn't just buy the product, you bought him for a year and a half, didn't you? So and that's why a lot of acquisitions happen. More acquisitions than most people realize happen because it's not necessarily about the product itself or the buildings or the assets, but you're bringing people on board.
Right.
And people are obviously an enormous value, if not the biggest asset of most companies. And it's also why, it's similar to the structure of your deal. When there's a typical acquisition, most acquisitions of a business, and if you're watching this or listening to this and you want to sell your business, you have to expect that the buyer is probably going to want you to stick around. Like you wanted this guy to stick around for a year and a half because you needed his brand and you needed his expertise, you needed his goodwill.
His network,
Yeah. So, and it's the same thing with you, Joey. Like if you ever were to sell your business, if I were to, buy School of Motion from you, there's no way I would buy your business without you being part of the package for at least a couple of years,
I'm aware.
And maybe you'll get a consulting fee, with it and whatever, but there's just no way because it's particularly in a small business.
We actually just went through this, Gene. We had an offer on the table, and it didn't work out, and that we'd gotten to the part where we'd started to negotiate things like that, and then it just kind of fell apart. But I knew that I was going to come along for the ride for at least, I'd say at least 2 years. And I have a friend who he sold his business a couple years ago, exact same size as School of Motion, and he's locked up, I think, for like 5 years. So it's pretty common.
Yeah. You get locked up that way. It's a standard thing. And so it should be known, again, by whether you're buying a business or you're selling a business, it's like super standard. The other thing is like the structure of your deal was like the perfect, it's almost unrealistically perfect. I'm not saying it's not. I'm just saying like, it's like, that's like what everybody dreams of. Like, I want to buy this company. I'm taking a risk. I don't know if this company's going to work out. So I'm not going to pay anything for it unless we make profits. Like that's what every business wants. Every acquirer wants to do is to minimize the risk. And you pulled that off. You were able.
It's pretty common. It's pretty common, Gene. And actually, like the friend who taught me how to do this, I just went in partnering on a deal with him where he did the exact same thing to acquire a pretty well-known marketing brand that owns a conference, and they own an online sort of academy, and they own a software product. And I think he acquired them for I think it's about $900,000. $0 down.
Right.
All of the money for the deal comes out of, he runs a marketing agency and owns other businesses, and so he can basically immediately probably double the sales that this thing was doing and pay for the deal out of that. And so and he's an amazing deal maker, so he also has all these clauses in there where if it doesn't work out, we're basically going to give the company back to you, but like we didn't lose any money. And so what I found is like when if you're just honest with the seller, when someone's ready to sell their company, they're usually pretty motivated, and there's a reason behind it. And if you can just help connect the dots for them, like to let them know you're going to get what you want. It may not happen on the time scale you were hoping. You may not just get this big check. It may take years. But as long as you're cool with that, I bet we can make this work.
I think that it's it can be common to do if the owner is coming on board. Like if I'm going to sell my business to you and you're like, hey, Gene, I'm not going to pay you unless we have profits from this business over the next 2 years. That's an incentive for me to say like, well, I'll tell you what, I'm going to keep working, this business. You're going to pay me some type of fee to do that, but I need to make sure that I am taking care of my interests, so that I do get paid out. So, most of these kinds of transactions usually involve with that, when that person just comes on board. I mean, to me, it's like, I think somebody would be crazy to just sell their business on the promise of future profits if they don't have some control over those future profits. I mean, it's just, I would never recommend a client doing that. But then in the structure that you're just talking about, the deal that you had, that makes perfect sense because the guy, the guy came and continued to work so he could look after that, which is great. And you also it's such a great, the way you structured it is great as well, because a lot of times they have to get banks involved, or they need financing, or they got to get other partners. You didn't have to do any of that, right? Because you're hey man, like if this doesn't make any money, there's nothing to pay him.
There's no outside financing. Yeah.
Yeah. So it's a brilliant deal. I mean, it was a great, idea. And before we even get to the second deal, just, just curious about that. How long did it take to put that deal together? And who did you involve in it? Like you just said, you're not the business guy,
Right.
You're the creative guy. So did you have attorneys involved? Was it your friend that did the whole thing for you, or an accountant? Like, tell me about like sort of what experts you got involved to even put together this deal.
Yeah.
Because I don't care if it's $50,000 or $5 million, it's still money. So you have to have people involved.
Yeah, exactly. So I mean, so my friend, sort of coached me through the process and sort of, he would like role play with me and explain to me like, okay, here's how you negotiate and this and that. So that was invaluable, and I was very, very lucky to have him. There's a lawyer that we've been working with for almost since the beginning, who I met through a mastermind group, and we've been good friends, and he's a really good business lawyer based out of Denver. So he did all the paperwork for it and made sure that everything worked out. And I'll say that, my experience, even with him, and we're buddies, so like I'm very blunt with him, he's very blunt with me. We have a great relationship.
Good.
I still find that like lawyers tend to be much more risk averse than business owners. And so I still found like, the counterparty would ask for something that to me was like, okay, well, if I was in his shoes, I'd ask for that too. That's reasonable. And we can put some parameters around that. And he'd say, just say no to that. And I'd be like, yeah, but I know this guy. I know that's not important to me. It's important to him. So let's just give it to him. And you do have to kind of push deals through, even little ones like we did. I find there's always some friction there.
Yeah, it's funny that you say that as well about attorneys. I've always found, I remember my dad telling me the same thing, which is really true. Like, attorneys are, the transaction is between you and the other business owner. Like, it's not, maybe it's only in the movies, or maybe it's like a very, very high corporate levels where they outsource these negotiations to attorneys going back and forth. It's usually mano a mano. You're with somebody, you're going back and forth. And you did the right thing. If this guy's making an ask of you, and you're like, hey, fair enough. If I was in his shoes, I'd be doing the same thing. That's reasonable. Like, nobody's trying to outgun each other here. They're trying to come up with a reasonable deal. And this guy was going to keep working for you for the next couple of weeks. So the last thing you wanted to do was like annoy him, or anger him because you took advantage. So the proper use of an attorney is really after the deal is done for them to sort of write it up. It doesn't mean you can't go back to your attorney and say, well, do you have any thoughts on this? But let's just not forget that attorneys are specialized in law. That doesn't necessarily mean they specialize in business, so they kind of know what's best.
Yeah. I mean, I'd recommend if someone's never done a deal like this, it can't hurt to spend an hour with your attorney and just say like, what are the 3 things that you want to warn me about? Warn me right now, and I'll make sure not to do those things. But attorneys, my attorney always tries to do what's best for School of Motion or Rolo or whatever business I'm talking to him about. But at the end of the day, your attorney's incentives are not exactly aligned with yours, right? They're working for the billable hour. And so, even though like, I don't think most lawyers are trying to screw your client or anything like that, but it's just human nature. If your incentives are not totally aligned, you always need to make sure that you're looking out for your best interests. The lawyer's looking out for theirs, your counterparty's looking out for theirs,
Yeah, that makes complete sense. Did you involve an accountant at all?
I'm trying to remember if we did for that one.
Because you probably didn't. I don't think you would need to, and I'll tell you the reason why.
Mm-hmm.
You're buying the business. Now I realize there's an accounting entry. I'm speaking as a CPA here,
Mm-hmm.
And I'm only saying this for those of you guys that are watching or listening that are involved in a transaction like this. Buying a business not that you don't completely not need an accountant, but it's the seller who needs the accountant. Because when you're selling assets, and just you bear in mind on this, in the future, Joe, if you sell your business, there's capital gains involved. There's from the sale because you're making the profit on this sale. So that's when you definitely need to have a good tax accountant involved to make sure it's structured in a way that minimizes your liability. Maybe it gets your assets get put into a trust.
Yep.
Maybe you can break out the type of sale so it's not as much capital gains. So it's the seller, I think, that has more of a need, which doesn't surprise me that doesn't come right to your head whether or not you're involved in accounts.
Yeah, so I'm trying to remember. I think on that first deal, I mean, I'm sure they were involved in the sense of like, we notified them this is happening, and especially because part of the deal was we're paying for the deal out of the profits from the sale of these products. So now we just had to have like separate categories to track those things separately, and we had to agree on what profit meant, like for those products. Because I mean, that's a lot trickier than most people would imagine. I'm sure, as you know.
Right.
Yeah. So Yeah, but I mean, you're exactly right. I mean, going through the exercise of dealing with maybe us getting acquired, I started learning about like basis and things like this that
Yes.
I still can't quite wrap my head around. I think that the way that we did both of the deals where we acquired the company, because we paid the owner out over time, and well, at least with the first deal, the owner came on and was on salary. And so I'm not even sure that it was a capital gain situation there. I think it was almost like, look, you're getting the money one way or another. We're going to call it a salary, but we all know that this was actually an acquisition. We acquired you.
Yeah. I can tell you that it's not even your concern. You know what I mean? It's really like however him and his accountant structured that. I mean, you're just writing a check.
Yeah,
so
exactly. Yeah.
Whatever it is, but then, and it's their concern really as to how that's going to be treated from a tax basis. And before we get on to the second deal, how'd you come up with the purchase price?
Yeah, so he had come up with the purchase price, and we negotiated back and forth a little bit and lowered it a little bit. In the end, it was basically like he felt like, okay, look. So the truth of the matter was he was burnt out trying to run this thing by himself, and he like a lot. And there are so many businesses like this out there. So if anyone's listening to this and they think, oh, this sounds cool, just go look a little bit, and you'll be shocked. They're everywhere. Businesses where you have someone who has a great idea and it turns out they can actually execute pretty well. And they're kind of like this solopreneur making this awesome thing. And what they underestimate is the cost of success. Oh my God, it worked. Now I have customer support. Now I have people saying, when's the next thing coming out? I still have to continue marketing the original thing, but now I have to make a new thing. How do I do that? I didn't make enough to like hire a team. So what do I do? And so really, the person's like floundering and the business slows down and it just kind of stops. And so that was the situation with this business. And so basically, I just looked at it and I said, okay, well, what you're asking is way too high. This number is also too high. Yeah. So I kind of tried to anchor it with him saying, even this 50,000 number is too high. Like your business is not worth that. However, if I take your product with my team and my expertise and we market it and we transform it and we build new products, but you're going to manage that and you're going to be the creative director on that. And I'm going to pay you exactly what you want over 18 months based on the sales of this. He looked at it and he's like, and he already had a full-time job that he was doing. So this was going to be like extra money to him, like a decent amount. He's like, yeah, that sounds fun. And then I don't have to run this thing anymore, but it gets to keep living. That's awesome. That's a great deal for me. And so he said yes. And so even though I technically overpaid, if you did like like a private equity firm came in and valued his company, they wouldn't say it was worth $50,000. But to us, it was, and it made its money back.
Yeah.
So, yeah.
It's overpaid is, because people say that all the time, I was just listening to an interview. It was actually a story, and it was an ethical story because it was in the news where this couple sold some like an African mask to a pawn shop for like $300, and then the pawn shop turned around and got it appraised and it was worth like $3 million.
Oh, wow.
And the pawn shop sold it for that, and then the couple came back and sued the pawn shop because they were like, "Oh, you cheated us, out of it." Meanwhile, the pawn shop like bought this mask, you know what I mean? And so it's like an ethical thing, like was the pawn shop wrong did they take advantage? And it's the same thing in your case. I mean, you're going to come up with a valuation that you think is reasonable for you, that makes sense to you. And I think you're kind of understating or you're playing down your knowledge a little bit because you're like, I'm not a business guy, but it sounds like there were some spreadsheets involved here, right? I mean,
there was
you had to have been like, yeah, we're going to buy this and we're going to take on this guy. So there's going to be these costs involved, and we're going to spend some money on marketing, I'm sure, whatever, for this product.
Yep.
But then you were like extrapolating out over the next 5 years what you expected it to bring in. And I'm sure you were like, okay, this is a return on it. And you're always judging that return on investment against like taking that $50,000 and sticking it in a bank account for 4% interest,
Right.
And, and by the way, when you did this, it probably was like,
it was not 4% when we did this. Yeah.
Yeah. So all of that makes sense. And one other thing I also wanted to comment on you, and I don't know if you're still in the business of doing this, but you just said that there's a lot of business owners out there that, are in that situation. There's a lot. And, people come to me all the time about starting up businesses, and I'm always like, don't start a business, man. Like, buy a business, because there's a lot of us. So are you looking for more? Are you constantly on the lookout for more deals like this?
I mean, my eyes are always open for it. Like, I'm not actively looking to acquire anything right now. But if I did, I think I would look for more things like the second acquisition, which worked a little differently, and there was some different reasoning behind it too, so we can get into that field too.
Let's talk about it. Let's talk about
okay.
it. So tell us a little bit about that second acquisition.
Yeah, so the second acquisition was called MoGraph Mentor, and it was an online school, just like School of Motion, been around about the same amount of time. They actually started a little bit before us, and they had a different business model. So our model's built on technology where we can do these sort of cohort-based hybrid. They feel like they're live, but they're not classes. And that's really scalable. They were doing actual live classes. So you'd have a Zoom call once a week, and and they were pretty expensive, and they were very hard to scale. And that business model wasn't working so well for them. So what they ended up doing was then just getting into traditional, let's just make these short instant access classes. You buy them and you get them, and they have a teachable teachable
site.
Let
me stop you for a second.
Yeah.
So how big an organization was this? Just so this doesn't sound like it was like one guy. This sounds like this was a company.
So he did have a small team. I think it was over the years, I think there had been full-time employees, but by the time we got to him, he was totally burnt out from running the business.
Okay.
And so it was just him, and he had some contractors, like some video editors and stuff like that. And he had a similar deal with his instructors where he was paying them a royalty if they made a class, and he sold it for them. And so when we were looking at that deal, there was a couple of considerations. One was they were a competitor. And I saw it as an opportunity to, take a competitor off the board. Maybe that's a little ruthless of me, but I was like, we can acquire them. They were not doing well financially. I was not making money. I mean, basically, the year we bought them, I think they were almost break even. I mean, it was like really not doing very well. And that's pretty common too, because if you have a business that lasts a long time, but you can never get it, in a velocity to hire a team to help you do it, so it's not all you're going to burn out, period, full stop.
Did you know this guy beforehand? Like, had you had a relationship with him?
Yeah, I mean, we had a very good relationship, actually. That's one of the cool things about our industry is that everyone, even people who are competing for customers, we're all very friendly with each other. And this guy's very, very, very nice guy. And in fact, for a while, randomly, he and his wife moved to Sarasota, which is where I live. And we hung out a few times, and he's an entrepreneur, so I just really get along with him.
Cool.
But
was he reluctant in any way to share his numbers? I mean, you are competing with him. And same for you. You just mentioned that you were involved in a potential deal to sell your company.
Mm-hmm.
Can you give some comment both from his aspect and yours about it's got to be full disclosure, right? You got to share. Were you comfortable?
Absolutely, yeah. Well, I mean, you have to be. I mean, the way I looked at it, and I can tell you from my perspective, when this much larger company was looking to acquire us, when it was like, hey, okay, we're under NDA, we need to see your books, send us everything. And, I'm like, okay, I mean, like, if you're going to buy the company, you're going to find out where the dead bodies are. Yeah. And there are every company has dead bodies, right?
Of course.
Oh, wow, what happened that quarter? Oh my God, right? What's that line of credit there? Why do you have that? So yeah, I mean, it doesn't bother me too much to share that stuff, if there's like confidentiality involved.
Yeah, it's the right attitude.
But when we acquired this other company, we asked, we signed an NDA, we had an LOI and all that, and then he sent over his books, and this deal was, I'll tell you what, our lawyers saved our ass on this deal. So this is where the lawyers came in really handy. So we actually used a different set of lawyers on this deal because we had started working with just like general sort of law firm in Sarasota. That understood Florida law because that's where we're incorporated, and they were advising us on this, and they structured this deal a little differently. So this deal, there was like the sticker price that he wanted for his business, which of course was more than it was worth. But we structured a deal where we're going to pay out over, I think it was also 18 months, and it was going to be tied to certain things.
Okay.
So one of the things was we need all of the original project files and video files and assets and everything for every single product you have. And we need all of your contracts that you have with, just basic stuff you would ask for.
Yeah.
He didn't have some of it.
Yeah.
And the stuff he gave us, we started going through and we're like, oh, this is incomplete. This is incomplete. And our deal was structured so that we still got to acquire those things. We didn't have to pay for them. And so in the end, the deal he said yes to, I think we ended up paying a third in the end. Like,
nope.
We actually, I think, ended up paying less for that business than for the first business.
Oh my gosh, that's unbelievable.
And it ended up being...
amicably, this guy wasn't, there wasn't any grudges or he wasn't angry because, paying a third of what he was originally asking for sounds...
I think
big discount.
In honesty, I think he was probably just happy to have this off of his books and not have to stress about it anymore.
Okay.
I think it was really stressing him out having this business that it had done fairly well for a while.
Right.
And we were always kind of neck and neck in the early years, and then I started hiring, and School Motion just grew. And he just kind of always stayed right around here.
I see.
And that's really, really stressful. And I felt for him, and it,
Sure.
And he's a really nice guy. So I think in the end he's probably happy to get something for his troubles.
Sure.
But what we ended up doing with this, this is a trick I learned from another friend of mine who has used this trick before, is most people would look at what this guy was selling and say, oh, those are products I can sell to my customers. And that's initially what I thought we would do. In the end, it turned out to be more valuable to take those products and give them away for free in exchange for email addresses to use them as lead magnets.
Sure. Okay.
I have a buddy. He has a business. He built this SaaS business that's aimed at designers that work on like websites and stuff. And he's like, how am I going to find leads to sell this to? So what he did was he went out and he found there's a bunch of websites where people will, I don't even understand why, out of the goodness of their heart, they'll build these libraries of like free icons or free fonts or free design elements or textures. And they don't monetize it. Right. And so he comes in and he's like, you have a thing here that's worth $0. How about I give you 25 grand right now, I'll write you a check. And now you've been a business that's been acquired. You've got 5-figure check in your hand. All I ask is you help run it for the next 6 months and then we'll transition. What do you say? And he gets yeses pretty easily in that case. Yeah. And then
he does it for the data.
He does it for the leads, basically.
Yeah.
And that's it.
What you're really saying is you're buying a customer list from this guy, wasn't it? In the end,
that's a way of looking at it. Yeah.
Yeah. Which again is not an uncommon thing to do, and different people value intangible assets in different ways. So sometimes people will buy a business for one piece of equipment because they know they can turn that around and generate revenues often. Like we talked earlier, people will buy a business for employees because they know they're going to provide that value. And then people buy business for intangible assets. And it could be a logo, let alone a customer list. And that's what you did, I guess, right? So you took this person's customer list and whatever data that they had, obviously customers and prospects, because they're out talking to the same people you are. And then you leverage that to market other products and services to them. Is that a fair statement?
Well, it's even better than that. So yes, we did that, but also we took, as an example, we took one of their classes that they were selling. Yeah. For $100 or something like that. We took it and we said, free class. Just sign up for a free account, which means you give us your email address, we can market to you.
Wow.
You get a free class, like an intro level motion design class.
Yeah. Great.
And, that thing generates 20,000 leads.
Yeah.
Now, for us, what is a lead worth? It's a lot higher than what it was worth for him to have a lead. Right?
Yeah. So you've got other things to sell.
And for us to make that class, if we were like, let's start from scratch and make that class, it would probably it would cost more than we paid for the whole business to do it.
Right, I got you.
Yeah. So you can buy assets that are products and turn them into lead magnets or just marketing elements.
Great advice.
Yeah.
So Joey, just a couple of minutes that we have left. So you bought these 2 small companies, and you have successfully converted them into return on investment, which is great. Give me some thoughts. When you go to buy another company someday, and I'm sure you'll stumble onto something, what will you make sure that you do or don't do in the 2 minutes that we have left?
Yeah. I mean, I think if we do another deal like this, and I'm sure in the future we will, it seems to work best when, you can kind of set up a win-win situation, right? And
Good.
in both of these cases, I'd say like, I'm much more interested in sort of the creative deal structure of like, okay, I'm buying this business to take a few of these assets and turn them into free gifts to generate leads. And then based on the sales of that, I can pay back,
Sure.
Yeah. So I guess the advice I would give is just try to educate yourself about the way deals actually work in the real world. I had the same idea I think everyone did, which is if I want to buy a business, it's going to cost at least $1 million. And, the business owner is definitely not going to say yes to anything lower than that. And I'm going to have $1 million check to give them. And that is not at all, that's not how any deal works almost. I mean, it's pretty rare, I think, especially now, to have an all cash deal like that.
Right.
That book, Buy Then Build, I think the author's name is Deeble Walker. I could be wrong, but it's an amazing book. It really opened my eyes to how you can structure things, how you can do this with no money, literally no money.
Yeah.
You can you don't even have to go to a bank. You can structure it so that it will pay for itself, or it won't. But if it doesn't, no big deal. But it will pay for itself out of the business. Yeah.
Great advice. And just a couple of takeaways on my side as well. As you're absolutely right. You can structure that. Plus, I mean, listen, buying a company nowadays and getting bank financing when prime rate is 8.5% as we're speaking, and business rates are higher. Sometimes it blows the deal out of the water. So you have to be more creative as to how you want to do your deals. And sellers, if they want to get out of the business, they'll provide their own form of financing. And they'll take less of a payout, or they'll work longer, or whatever, so because they've got an interest in exiting too. So you have to be creative. It's great stuff. It's great.
Yeah.
Something else you want to add? I'm sorry.
Yeah, I was gonna say just this is really short. So my buddy who taught me all this stuff, I'm pretty sure he's the one who said this to me. He said, your number, my terms, my number, your terms. And so that's kind of shorthand for what we're talking about here. And so just live by that. If they want that number, there's a way to make that number work. There always is. Yeah.
Yeah, that's great. That's great advice. It is great advice. Joey Korenman is the founder of the School of Motion and the co-founder of Rolo. We have been talking about buying companies, or even if you're somebody that wants to sell your company or assets within your company, some advice here for you as well. Joey, thank you very much. Great speaking with you. Thanks for spending the time on both of these episodes. It's awesome speaking with you, and I hope we can do it again sometime in the future.
Yeah, it was fun. Thanks again, Gene.
Thank you. Everybody, you have been watching and listening to the Hartford Small Biz Ahead podcast. My name is Gene Marks. If you want some advice or tips or help in running your business, please visit us at smallbizahead.com or sba.thehartford.com. Until we meet again, we'll see you soon. Take care.